Okay, markets were down really big today. It started out up and down. It was down to start, then went up and then down. Then all of a sudden, it just started to tank. Big news was banks. The Silicon Valley Bank in California, they had to take some write-offs or write-downs of some of their assets. They had to raise some capital, diluting their investors, and it just trickled down through all the banks. If you look at the banks today, all down a ton. Now, some things I want to make note though. GE tends to be a very volatile company. Up today. Microsoft only down 0.5%. I was happy to see this because at one point Google was up a little bit today. Same with Meta. So Apple was as well. So everything was taking a big hit today. What was that? Okay, Chipotle up a little bit today. One of the other notable ones. Not really many notable ones, but again, banks were down a lot. There's a lot of fears out there that a lot of banks are going to have to do a lot of write-downs. I don't know if it's the level of '08, doubt that, but the point is things were down a lot today. So guys, two things I want you to do. If you're new to the channel, subscribe to the channel. And for everyone watching, please share this with somebody out there. It's just a way of explaining things. Now remember, any given day, things are going to be good or bad, and the news is going to follow what's good or bad. It's not necessarily going to be driven by reality. Remember, it's much easier to go on fear and to sell people on fear. This shows a lot of fear. I'm not trying to scare you. What I'm trying to do is show you how widespread the losses were today. Banks took it especially hard. Now, why did all of a sudden people just start selling off everything? I don't know. It just literally was like back and forth, and then collapse. And almost a straight down shot and stabilized in the last half hour. Okay. This is part of cycles. Now, as you know, I believe the market is massively overpriced. Let me show you, for those of you who have not seen this before, it's a very popular thing that I show on the site. This is, and let me actually put the exact number up here, 3918. As of today, this is my stock market to GDP ratio. I do this all the time to make sure 3918.32. It's showing you right now that the S&P going back to 1929 is 60.9% overvalued from its historical averages. Now, is that a lot? Yeah, it's a lot. When we're 30 or 50% overvalued, not including dividends, the next 10 years are negative. So, not including dividends, based on history, we're looking at negative returns on the S&P for the next 10 years. In fact, according to this, we can expect to be below today's levels of maybe even 3,500 in 10 years. I don't know. This is all speculation. However, this is the single most reliable metric in the stock market at any given time, according to Warren Buffett. And we even have the 10-year cyclically adjusted PE ratio, which shows that about the S&P fair value is about where this is right now. So things are going to be tough, and the news will follow where stocks go. Banks were tough today. Banks got hit hard. Also this morning, unemployment numbers, the first time unemployment, I believe, was higher than expected. And even good numbers are not good things today. Why? Because the Fed is worried, the markets are worried about the Fed raising interest rates. Why would the Fed raise interest rates if good news comes out? Well, to them, they don't want to have better unemployment numbers. They don't want to have more people working. They don't want to have wages going up. They don't want to have good consumer spending numbers coming out. The Fed wants inflation to go lower. How do you do that? You raise rates. What does raising of rates do for the stock market? It drags down stock prices. You know, one thing I did talk about today, look at the 90-day Treasury today. So let me pull this up on Market Watch. Let's look at rates. The 10-year Treasury is at 3.921. Let's look at the 90-day Treasury as of this very second. Oh, it fell back below 5%, 4.983%. That means you can give them government money for 90 days and get 1/4 of this, so it's about 1.25% every 90 days. Guys, look at this. This is the 3-year chart. Back in January, end of 2021, a mere 15 months ago, it was 0.08%. 0.08%. That means if you gave the government $1 million, you were getting $800 every year from the government for that. That same $1,000,000 will get you almost $50,000 a year versus 800. That's a great place to put money for 90 days. And you have actually you have practically no interest rate risk. And that is what people want. That was what drove stock prices so high. When interest rates were 0%, people were like, well, why would I put money in the bank? I can get 2% dividend from the S&P. I might as well put my money in there. And they viewed it as 2% money. I viewed it as, well, if stocks go very high, yes, I might be able to get $20,000 on my $1,000,000, but I'm now risking my $1,000,000 not being worth $1,000,000. And that's what happened. And that's what's probably going to continue to happen based on this stock market to GDP ratio. At some point, GDP is going to continue going up, but at some point, stocks are going to have to fall to meet the value. And at some point, this will be a positive number. We're never going to be overvalued forever. We're not going to be at value. This is what the market does over long periods of time. It goes up like this. And fair value is right here. So you're either over or undervalued. Now, again, if this makes sense to you, this is why you need to subscribe. It's not as complicated as it may seem. The more and more you repeat it, the more and more this will help you when stocks go down. When stocks go down and people are scared and people are upset, you'll have to get to the point where you go, I'm okay because I realize cycles happen. I saw something. Today is March 9th, 2023. Does anybody know what March 9th, 2009 was? It was the bottom of the financial crisis. I believe the S&P hit that glamorous number of 666. Since then, without dividends, the S&P has done 13.5% a year. If you bought at the peak, which was October of 2007, you made 6.5% per year. 6.5% versus 13.5%. Now, question for you. Did the outlook of the world and the economy and the stock market look better here or here? Obviously here. That's the thing you have to remember, guys. You're going to get the best returns when stocks are down and you're investing money and when things look the worst. In order for stock prices to go down and in order for individual company names to go down, there has to be bad news. Now, a lot of the times as a stock just goes down just because it's just the cycle, they will perpetuate bad news to fight it. I look at Alibaba, for example. At $3.10 per share, nobody cared that Alibaba was an ADR, which meant you didn't actually own pieces of the company. No one cared about that. All of a sudden, the stock falls to 150 and 100 and even lower. People suddenly go, oh my God, it's so terrible. You don't even own a piece of the company. Well, that's always been the case. That's always been the case for ADRs. It just became part of the story to justify the stock price falling. You look at a company like Google. I remember when we did videos on Google and I was like, I really don't like Google at 150. Get messages from people. Google will never go below 100. Suddenly it did. Now all of a sudden people are worried about Google. Oh, what about, advertising? And this is it's okay. Advertising is down. Yeah. And guess what? In the Great Depression, companies either went under or the ones that survived made a lot less money. Does that mean they made a lot less money forever? No. There was a great quote I read yesterday by Howard Marks. And let me pull it up exactly because I put it into our chat. It's an important quote. It's much easier to make money when the world is depressed because when it stops being depressed, it's like a compressed spring that comes back. That's Howard Marks. Guys, that is why you invest when things look bad because eventually things will not look bad anymore. You go look at the history of the stock market. Going back to 100 some years ago, and what has happened since then in this world and in this country? There's been lots of great news and a lot of bad news, but you'll always find that the time you wish, if you could go back in history and pick the points of which you'd invest, you go circle those points, they're always at lows in the market. The news was bad. The outlook was bad. And guess what? The world was not ending. It was just depressed. Just like, guys, when you're sad at home, you can't imagine being happy again. And when you're happy and euphoric, you can't imagine being sad. That's the world of investing. But that's why we're here. That's why you need to follow our channel. Because when things look the worst, people out there will be saying to me, not you, because you'll have learned the lesson, but there'll be other people saying, this guy doesn't get it. The world looks terrible right now. But it's not going to be. The world is going to get better as time goes on. It absolutely will. It never hasn't, and it never will stop being that way. Are there going to be issues? 100%. There's going to be issues. But the point is, when stocks are falling because of those issues, they tend to fall further than they should. And those are good opportunities to buy. And if you had bought on March 9th, 2009, 14 years ago today, you'd have made 13.5%, even after a 20% fall in the S&P on your money without dividends. Add in 2% with dividends, you're at 15.5% on your money over a 14-year period of time. Now, granted, do I think that's going to last? No, I think things are going to go further down, but you're still going to beat whether versus buying at the peak in October of 2007. Go look at the peak of 2000 versus the bottom of 2003. Returns are very different. But what was the story at those times? At the peak of 2000, the peak of 2007, every single peak, things look great. Every single bottom, things look awful. Markets fall and markets bottom out because of the fear of things happening, not when they actually do happen. The fear is what drives prices down. The reality doesn't do that as much. Guys, again, follow this channel and please send this to somebody who needs to hear this. Send this to 5 people who need to hear this. Trust me when I say your life will be better because of it. Thank you.